Crypto events to watch: Celo upgrade plus Fed CPI and CME Bitcoin Futures. This week in crypto could define your next trade. Welcome to Money Minded, your daily destination for global financial storytelling, where we decode complex economic events and deliver practical market insights. In today's episode, we're diving deep into a triple threat of events that could send waves across the crypto market: the long-awaited Celo blockchain upgrade, the release of the U.S. Consumer Price Index (CPI) data by the Federal Reserve, and the CME Bitcoin Futures expiry. Now, why do these three events matter? Because they sit right at the intersection of crypto's internal innovation and the global financial system's external forces. One is a technical leap in blockchain infrastructure. One is a macroeconomic trigger with global implications, and one is a market mechanism that quietly moves billions. Taken together, they form a crypto calendar that traders and investors simply cannot afford to ignore. Let's start with Celo, a project often flying under the radar, now making a bold move by transitioning from its own Layer 1 to becoming an Ethereum Layer-2 using the OP stack. This is more than just a software upgrade. It's a strategic pivot that could attract new users, boost on-chain activity, and influence DeFi capital flows. Next, the CPI report from the U.S. Federal Reserve is more than just a monthly statistic. It's a pulse check on inflation, interest rate direction, and investor confidence. Whether inflation cools or heats up, crypto assets like Bitcoin and Ethereum often react faster than traditional markets. And finally, we have the CME Bitcoin Futures expiry, a technical yet crucial event that tends to generate short-term volatility, driven by institutional positioning, derivatives hedging, and the infamous Max Pain theory. In this video, we'll break down each of these events, not just explaining what they are, but what they mean for you. You'll learn how to anticipate potential market reactions, spot trading opportunities, and prepare for price movements in both the short and long term. So stay with us, because if you want to stay one step ahead of the market, timing is everything, and this week, the clock is ticking. Chapter 1: The Celo upgrade. Let's begin with the technical event that could become a quiet game changer: Celo's major blockchain upgrade. For those unfamiliar, Celo started as a Layer 1 blockchain focused on mobile-first access to decentralized finance. Its goal was ambitious: bring crypto-powered financial tools to billions of people in emerging markets via their smartphones. Over the years, it gained support from major backers like Andreessen Horowitz, A16Z, and Polychain Capital, building an ecosystem of apps focused on payments, remittances, and savings. But as the Ethereum ecosystem matured, especially with the rise of Layer 2 networks like Arbitrum, Optimism, and Base, Celo's developers faced a tough question. How do you stay relevant as a standalone Layer 1? Their answer: don't compete, connect. With this upgrade, Celo is transitioning into an Ethereum Layer 2 using the OP stack, a modular software framework developed by Optimism. This isn't just a rebrand, it's a full architectural transformation. By leveraging the security and liquidity of Ethereum while preserving its own mobile-first identity, Celo aims to integrate seamlessly into Ethereum's growing Layer 2 economy. Here's why this matters: security and liquidity boost. By becoming an L2, Celo inherits Ethereum's security guarantees via roll-up architecture. It also opens the door to greater liquidity, as it can now more directly tap into Ethereum native assets and DeFi protocols. Developer incentives. Celo's compatibility with the OP stack means that developers can now build dApps using familiar Ethereum tooling while targeting Celo's mobile user base. That's a powerful combination for growth. Onboarding emerging markets to Ethereum. Celo has always been strong in markets where mobile-first access is critical. Now, that on-ramp becomes a bridge directly into Ethereum's decentralized ecosystem, potentially unlocking millions of new users. Ecosystem alignment. The transition aligns Celo with Ethereum's long-term roadmap and reduces fragmentation in the L1 space. Instead of diluting resources across competing chains, Celo is choosing to become part of the strongest decentralized network on the planet. Now, what could this mean for Celo, the native token? Typically, major upgrades create speculative momentum. Traders may position early, betting on new use cases and adoption. But there's also risk. If the upgrade is delayed, buggy, or fails to drive new usage, expectations may unwind quickly. From a trading perspective, watch for pre-upgrade accumulation zones. Monitor on-chain developer activity and transaction counts post-upgrade. Track ecosystem announcements. Are new projects deploying on Celo L2? Fundamentally, this is a bullish long-term move, but it requires careful short-term observation. The Layer-2 space is heating up, and Celo's decision to join the Ethereum family puts it in a better position than trying to go it alone. In summary, Celo's upgrade is more than just a technical milestone, it's a strategic pivot. By integrating with Ethereum through the OP stack, Celo is betting that the future of blockchain isn't about standing apart, but plugging in. And if that bet pays off, Celo could find renewed relevance in a fast-evolving crypto landscape. Chapter 2, CPI Report and the Federal Reserve. Now we move from blockchain upgrades to macroeconomic shockwaves. The upcoming Consumer Price Index, CPI, report from the Federal Reserve, arguably the single most market-sensitive data point this week. But why does a government-issued inflation number matter so much for crypto? Because in today's financial environment, crypto doesn't operate in a vacuum. Bitcoin, Ethereum, and the broader market now behave more like high-beta risk assets, closely tracking monetary policy expectations, dollar strength, and bond yields. And at the center of all that? The CPI report. Let's break it down. What is CPI, and why does it matter? CPI measures the average change over time in prices paid by consumers for goods and services. In other words, it tells us how fast prices are rising, a proxy for inflation. The US Federal Reserve uses this data to guide its interest rate policy. If inflation is too high, the Fed may raise rates to slow down the economy. If inflation is cooling, it might pause or even cut rates. And as we've seen repeatedly since 2022, interest rates and crypto are deeply connected. Higher rates increase the yield on government bonds and cash, making riskier assets like Bitcoin less attractive. Lower rates tend to push capital into speculative markets, including crypto. So when CPI comes in hotter than expected, markets often sell off in anticipation of rate hikes. But if CPI surprises to the downside, crypto tends to rally as hopes for looser monetary policy grow. Current market expectations. This week, analysts are watching the CPI numbers closely. Core inflation, excluding food and energy, is expected to slow slightly. But sticky categories like shelter and services remain a concern. Markets are pricing in a 70 to 80% probability that the Fed will hold rates steady at the next meeting. A hotter than expected CPI could throw that off, increasing the odds of a hawkish pivot. And that would ripple directly into crypto prices. What to watch for? Headline versus core CPI. Core inflation is more important for policy decisions. Watch for divergence between the two. Market reaction time. Crypto markets often front-run traditional assets. Watch BTC and ETH price moves within minutes of the CPI release. Dollar index, DXY, and bond yields. A rising dollar often correlates with falling crypto prices. Conversely, a weaker dollar can support a BTC breakout. Volatility traps. Be cautious around CPI hours. Whales often exploit volatility to trigger stop losses and accumulate positions. How to prepare as a trader or investor. For short-term traders, set alerts for the CPI release time. Avoid over-leveraged positions going into the announcement. For long-term holders, CPI prints are less about timing the market and more about understanding the macro cycle. A cooler print could signal that we're moving toward a more accommodative Fed, bullish for crypto in the medium term. For analysts, look beyond the number, focus on the market reaction. not just the data. In summary, the CPI report is more than just a data drop. It's a temperature check for monetary policy and, by extension, for the risk appetite in the crypto market. Whether Bitcoin consolidates, breaks out, or pulls back may hinge on this week's inflation narrative. Crypto has matured. It's now deeply tied to central bank behavior. And that means macro calendars must become part of your crypto playbook. Coming up next, we explore another event that blends traditional finance with crypto's frontier. The CME Bitcoin Futures expiry. You won't want to miss what institutional money is doing behind the scenes. Chapter 3, CME Bitcoin Futures expiry. Now let's talk about an event that flies under the radar of retail investors but is critical for institutional crypto flow, the CME Bitcoin Futures expiry. At first glance, this sounds like a technical derivative event. But in reality, it's a powerful liquidity shift that often leads to significant price volatility, directional moves, and institutional repositioning. What are CME Bitcoin Futures? The Chicago Mercantile Exchange, CME, launched cash-settled Bitcoin futures in 2017, allowing institutional investors to gain exposure to Bitcoin without holding the actual asset. These futures contracts trade monthly and quarterly, and they expire on the last Friday of each month, which makes this week's expiry highly relevant. What makes CME Bitcoin Futures special is who uses them. We're talking about hedge funds, macro desks, and big institutions who trade Bitcoin as part of a broader risk portfolio. Unlike retail-focused perpetual swaps on Binance or Bybit, CME contracts represent real positioning by deep-pocketed players. Why does expiry matter? When a futures contract expires, traders must settle their positions either by rolling over to a new contract, closing it, or letting it expire. This rebalancing often results in unusual price action, especially when combined with market catalysts like CPI reports or technical events. Here's what typically happens. Increased volatility in the 48 hours leading up to expiry. Price manipulation risk near the settlement price, as traders try to pin the price for profit. Short squeezes or long flushes, depending on where the majority of open interest lies. The max pain theory. One key concept here is that max pain, the price, the level at which the largest number of option contracts expire worthless. While it's more common in options markets, the theory often applies loosely to futures expiry as well. If the majority of open interest is long BTC at $72,000, for example, and the price hovers around $70,000, some traders may attempt to push the market to a zone where the most counterparties lose, maximizing pain for the majority and profit for the few. This creates short-term dislocations that traders can either avoid or exploit. What to watch this week? Open interest distribution. Track where the bulk of positions are placed. Look at CME data and derivatives dashboards like CoinGlass or Skew. Funding rates and basis gaps. A wide spread between spot and futures may indicate aggressive positioning and lead to snapbacks around expiry. Price action 24h before expiry. Often, Bitcoin will make a fake move in one direction before snapping the other way post-expiry. Correlation with CPI timing. This week's expiry comes just after the CPI report. That's a 1-2 punch that can lead to unpredictable reactions, especially if the CPI triggers a major market repricing. Trading strategy considerations. If you're a swing trader, be cautious of false breakouts midweek. Use tight risk management until expiry passes. If you're an investor, understand that expiry volatility is noise, not trend changing unless coupled with macro confirmation. If you're short-term focused, look for signs of whale positioning, block trades, unusual volumes, or front-running behavior near max pain zones. Final thought. CME Bitcoin Futures expiry is one of those events that can feel invisible until it suddenly moves the market. It represents the hidden hand of institutional capital, shaping Bitcoin's short-term trajectory in ways that often catch retail traders off guard. As crypto matures, Understanding derivatives flow becomes essential. Futures, options, and expiry dynamics are no longer the fringe, they're now part of the core story of Bitcoin price behavior. In the next section, we'll bring everything together: Celo's upgrade, the CPI report, and CME expiry, to draw conclusions about what this week might look like and how you can position accordingly. Conclusion? Let's bring it all together. This week is not just another ordinary moment on the crypto calendar, it's a convergence of three powerful forces that can reshape both short-term price action and long-term investor confidence. First, the Celo upgrade marks a strategic shift within the blockchain ecosystem. By moving from a standalone Layer 1 to an Ethereum Layer-2 via the OP stack, Celo isn't just optimizing its technology, it's aligning itself with the strongest ecosystem in decentralized finance. If successful, this upgrade could make Celo one of the most accessible, mobile-friendly Ethereum rollups, driving real-world use cases, especially in emerging markets. For developers, it means a new home for scalable dApps. For investors, it opens the door to speculative opportunities tied to Celo's adoption curve. Second, the CPI report from the Federal Reserve is more than just a data point. It's a macroeconomic pulse check. In a world where crypto assets have become increasingly correlated with interest rate cycles, inflation data can't be ignored. A hotter-than-expected report may trigger fears of tighter monetary policy, stronger dollar positioning, and crypto weakness. Conversely, a cooler print might reignite risk-on sentiment, fueling a relief rally across Bitcoin, Ethereum, and altcoins alike. And third, the CME Bitcoin Futures expiry reminds us that behind every price chart is a game of strategy and positioning. Institutional money doesn't move without reason. The expiry may generate brief volatility, fake outs, and short squeezes. But it also offers valuable insights into sentiment, especially when combined with the CPI data and technical trends across exchanges. So, what can you do with all of this? Stay informed. Knowledge is your edge. Track these events in real time, not just what happens, but how the market reacts. Control your exposure. If you're trading, reduce leverage and size appropriately around high volatility events. Zoom out when needed. Macro shocks may shake prices temporarily, but long-term narratives, like Celo's evolution, play out over months, not hours. Watch for correlations. Bitcoin and Ethereum might move together after CPI, but smart money will rotate between sectors. If Layer 2s gain favor, Celo could benefit. If volatility spikes, derivatives volumes will surge. At Money Minded, we believe that great financial decisions are made at the intersection of story, signal, and strategy. That's why we don't just report the news, we explain what it means for your portfolio, your mindset, and your path forward in the crypto economy. If you found value in this breakdown, make sure to like this video, subscribe to Money Minded, and share it with someone who's trying to make sense of the fast-moving crypto market. And drop a comment below. White right pointing backhand index. Do you think the Celo upgrade will push it back into the spotlight? White right pointing backhand index. How do you expect Bitcoin to react to this week's CPI print? We'll be watching closely and covering every move in upcoming videos. Until then, stay sharp, stay curious, and stay money-minded.